Hello everyone, very good evening. Myself Saloni Gupta. Please confirm my audibility and visibility so that we can start our today's session. Please confirm me everybody. I hope everything is fine, everything is perfect. So yes, just now we have completed our ABFM unit before this class. I hope you watch all those sessions like from 8:30 to 9 we have ABFM session in YouTube, and from 9 to 9:30 I have ABM session on YouTube. So I hope you watch every day these two sessions, and if you're not able to watch the live, then recording is still aware there. So please do watch the recording sessions as per your pace. So yes, we have started our module D, and the name of the module is credit management. We have completed one unit also of this credit management. Today is the second unit and unit number 18, that is the analysis of financial statements. So as you can see, this particular unit, this is related to your accounts. So you all have studied accounts in your GIB. So we have to study here what mostly all the scenarios which you have studied in JIB, all the basics, fundamentals you already know. What is cash, what is stock, what is debtor, what is creditor. Here is just the advanced version of this. Before starting this session, so we are launching our selection batch. This is all in one course, and the medium for this batch is either in English or in English. So I'm covering two subjects, your central banking subject and your ABFM subject in paid classes. Central banking will be in bilingual, whereas ABFM will be in English. And in YouTube, I'm taking ABM. So this is all in one course. What else? What are the other benefits you will be getting? That is, you will be getting the live sessions. 250 live classes will be there of every paper. Then early morning and late evening classes will be there. There will be another sessions for making your concept more clear. The preparation will be in advanced version because exams are coming every, you can say, year. The level of the questions are getting high, so according to the level of the examination we are preparing your syllabus, we are designing your syllabus so that you should not leave anything behind. Again, we have weekly live doubt and revision classes. Another benefits you will be getting is that if you are unable to watch the live classes, still the recording is there 24/7. You can watch the recordings, you can download the PDF, you can revise the PDF. Sectional test will be there, mock test will be there, covering each and every unit, each and every topic. Case study will be there and numerical based tests, and 20 elective paper tests we are also providing to you. So overall, this package is very good for you. So go and grab this course, enroll now, and we will be starting our classes very soon. Here, so everything is fine. I hope the audibility and visibility. No. Let's start with the session. So yes, we have, for any business organization, okay, we need finance, we need funds to start any business. If we want to expand our business, still we need funds. If we want to acquire any business, we need funds. If we want to, you can say, invest on any other project, we need funds, we need finance. So for, you can see, for every purpose, for basic to advanced purpose, you need what? You need finance. So we have different sources of finance. The first one is basis, on the basis of time and on the basis of ownership. On the basis of time, we have two types of finance: the short term and long. Short term means the period is very small, that is less than 1 year, and long term means the period is the more than 1 year, that is 5 to 10 year, 10 year, 15 years. On the basis of ownership right, we have two funds. Owners fund means the owner, the company's owner, the fund he is carrying, that is owner's fund, means the capital which he will brought to the business. And the next is borrowed fund. when the owner is borrowing funds from any financial institution, from any financial sector, and you can also say it as debt, the borrowed money. That is what the borrowed funds. So basically, for every business organization, there are two types of finance available on the basis of ownership: the owner's fund and the borrowed fund. And with these two funds, the business operates. So, what are financial statements? What are they? So, financial statements, again, we need to prepare everything. If we are working in a business organization, we need to prepare our profit and loss account. We need to get our net profit, net loss, financial statement, cash flow, fund flow, working capital. So everything is required in the business organization. So for that, we need what? We need to prepare financial statements where every activity should be recorded in of the company. Every financial performance activity should be recorded there. That are financial statements. So these are what a written records that includes all the business activity and performance, financial performance of the company that is related to funds. In financial statements, the balance sheet provides an overview of assets and liabilities. So you know your balance sheets. Okay, assets here is capital and liabilities, and this side is what? Your assets. So you have equity, share capital, you have your owner's fund, you have your reserves. On assets, you have cash in hand, cash at bank, any kind of investment you have done, all the type of tangible, intangible assets. So we know the basic format of cash, the balance sheet. The income statement, they primarily focus on what? The revenue and expenses. Clear? See, we know we have what? We have our capital, then we have our assets, we have revenues, and we have expenses. Okay, so for capital, for analyzing the capital and asset of a business, what we prepare what? Tell me, you all are watching, please confirm me what we prepare in this case. So we prepare balance sheet, and for revenues, or you can say income. What we prepare profit and loss account. So for revenues and for expenses, how much we had done the expenditure, how much the revenue comes, how much income we have generated, we all record where? In fine PL account, that is profit and loss account. Next comes what? The cash flow statement. It basically tells that, see, we know we have seen your balance sheet. Okay, the owner says that, okay, I have seen my balance sheet, everything is fine. But if I want to see that how much cash has been inflow, the cash inflow, the cash outflow is done, basically the positive and negative aspect of cash. So it is helpful to determine what's the cash flow statement. So cash flow statement help us to determine the positive and negative of our what? Cash. How much cash the inflow has done, and how much the cash outflow has been made. Statement of changes in equity record how profit are retained within a company for future growth. For everything we need to record in the financial statements, so that we may know a better idea that either we are making a good in our business, we are making the profit in our business, or we are making loss in our business. So to know this properly, we have to prepare every type of account in our business organization. Done. So what are accounting standards? Again, every company has to follow the same accounting standards. Okay, so if every company they follow different accounting standards, different policies, so it is difficult for any investor to invest in such companies. It is required to follow the same manner, so that what you are recording in your business, the same he will record in their business. Accounting standards are written policy documents issued by whom? Government, and with the other regulatory body. And what is that? The Ministry of Corporate Affairs, in the consultation of National Financial Reporting Authority. So these two are important. The regulatory body is Ministry of Corporate Affairs, and in consultation with whom? NFRA, that is National Financial Reporting Authority. So it includes the recognition, the all the expenses and all the income should be recognized properly. The measurement that which everything should be measured in a proper way. If you are taking a depreciation as written down value method or SLM, so you need to be consistent over that. Presentation should be done properly, and everything needs to be disclosed in a good manner. Now, what is profit and loss account? So profit and loss account, it basically shows the net profit and net loss of what? Of the business for the accounting period. So it is what? It is a statement of income and expenditure of an entity. Every PL account, it will basically tell this account is prepared in order to determine what? In order to determine your net profit, in order to determine your net loss. Because from this profit and loss, you will get an idea that am I making a profit in my business or I'm making a loss in my business. So it occurs during an accounting period for a business concern. That is why it is required to calculate the net profit and net loss. So what are the items you will include in PL account? The gross sale, cost of goods, okay, then gross profit, operating profit, profit before tax, tax, profit after tax, interest. So we have one statement for this, okay, like if you need to calculate that what is the actual profit in your company. Okay, so for income statement there is one income statement. What is this income statement? From sales, if you will deduct your variable cost, you will be getting contribution. Again, if you will deduct the fixed cost, you will be getting EBIT, that is earnings before interest and tax. That is the this thing, profit before interest and tax. If you will deduct interest, earnings before tax, what is that? The profit before tax. If you will deduct tax, you will get earnings after tax, or you can say profit after tax, and this is what the net profit. This is what. Okay, got a clarity? This is how we solve. Now, next is what? The cash flow statement. So, what is this cash flow statement? Cash flow statement, it basically tells the cash and cash equivalent, the inflow and outflow of the cash in a particular business. So, for this, we need to calculate three types of components. It includes under cash flow, that is the operating. Operating means what? For daily transactions, like for revenue, for giving wages, for giving salaries, what you are receiving. So, everything should be included in operating cash flow, received or expended for conducting business. Then investment cash flow, that is, it includes all the long term nature of what? Your investment. Like suppose you have purchased any machinery, that is will be recorded in investment cash flow. You have sold any kind of asset and you have got capital gain, so you will going to record in investment the selling amount. So it includes the investment purpose, the purchase and sale of machinery, the investment, all these things they will include where? In investment cash flows which you are investing. Done. And financing cash flows, it basically tells you the financial structure of the company. Financial structure of the company. So it includes the shares, debentures, how much capital you are requiring in your business, how much you have taken the debt from any external sources to run your business. So the story of financing the company, it basically tells what? The financial structure of the company. It is related to capital and debt. And debt is what called? It is called again the borrowed money. It is known as borrowed money. Now, sometimes you have a question in your mind that why cash flow is prepared? Why cash flow is prepared? If you are preparing PL account, if you are preparing balance sheet, so why it is prepared? Suppose in the balance sheet, you know that you have sold the goods, okay, on credit. You have sold the goods on credit. So your bills receivable are, let's say, 1,000. Let's say 10,000. Now, these bills receivable are outstanding. They have not paid you the money. You have generated income, but it is not being shown in the statement of accounts. It is not being shown in the balance sheet because in actual you have not got your money. You know that you will get this money after some time, but actual right now you're not getting this money. Cash flow statement is basically tells that the positive and negative of the cash flow. Cash flow statement is prepared to provide information about an entity's receipts, how much the entity is receiving the cash receipts and cash payment over a period of time. It helps determine whether a company has enough liquidity or not. You know that you are getting your 10,000 rupees after a someday, but right now that is not in your liquid, that is not in a cash amount it is being get. It basically tells that a company has enough liquidity or cash to pay its expenses or not. It helps in predicting future cash flows, then which and this future cash flows will also help in predicting the budgets for future. So all are related to one another. That is why we prepare what cash flow statement. What is fund flow statement? Again, fund flow statement, it basically tells that from where the money is coming, from where the money is coming, and and how money is being, how expenditure is being done, how expenditure is done. So we give answers to two questions in fund flow statement: from where the money is coming and from where the money is going, from and to where the money is going, to where the money is going. It is a financial report that shows where a company's money comes from and how it is used in a over a specific period of. It includes different components. First is sources of funds and second is users of funds. Sources means where the money is coming from. Suppose you have taken the loan from the bank, the cash is in positive. You have sold your building, you have sold your land, then cash will come. If the company has issued new shares to its investors, then investor will purchase the share and they will give you the money. Operating profit, so all these are what sources of fund. Now uses of fund, if you have paid any kind of debt with interest, if you had paid dividends to your shareholders, if working capital, that is day to day operating business, the capital is required, it is increasing. So these are the uses of fund. Very important purpose of analysis of financial statements by bankers. So how, what is the purpose of analyzing the financial statements? For assessment of performance of the banking for any financial position, for estimating the future performance, that in future what will going to happen to our business. Okay. So for estimating the cash inflows, for making the budget for the future, detecting danger signals like the bills receivable. You know that this money will you will be getting after a few time, but now, as of now, you are not getting your money back. So this is what a danger signal might be. You can, this money, the person will go and run away, he will not going to return that money, so this particular money will become the bad debts also. Clear. Assessment of credit requirements, how much credit you are giving to your particular person if you are selling goods to them. Examining the fund flow, cross checking means verifying. Techniques used in analysis of financial statements. So there are particularly three techniques used in analysis of financial statement. The first is fund flow analysis. We have seen now trend analysis and ratio analysis. So what is this trend analysis? So trend analysis is what it is the purpose of evaluating the past data. Evaluating what? The past data. The past data for what? For identifying different patterns. Evaluating the past data to identify the patterns of the company. To identify the patterns and make informed decisions, or it would be predictions or behaviors in the company. So it mainly tells that the what is the trend going in the present scenario. It evaluates from the past data, from experience, from the past analysis of data, we experience all the things which has already occurred in our company, and in the coming scenario what are the changes we can make so that we can get a huge profit from any source. We can make different predictions about any kind of change which is happening in the future. That is why we do what? Trend analysis. Like for example, there's a company. Okay, let's take the name of the company ABC Limited. Now, this particular company revenue is consistently declining over several quarters, over several months. Now, this trend analysis, it will help us to find that why the revenue is being declining of this company. What are the reasons behind that? This company was very good, but from the past 1 year, 2 years, the revenue has been declining. So you need to find the reasons behind that. You have to identify the reasons. So for identifying this reason, which type of analysis is helpful? That is the trend analysis. Now, ratio analysis, very important from the examination point of view. Ratio analysis is what it tells the financial health of the company. Financial health of the company. It is a method of examining company's balance sheet and income statement so to know the efficiency, profitability, operational liquidity of the company. Again, it includes a variety of financial data because from only one or two type of data, we cannot analyze the whole company. We need a lot of data. We need a lot of information for analyzing a variety of financial data about a company. So in ratio analysis, we will be studying liquidity, profitability, leverage, coverage, turnover, debt turnover ratio, all these things. So liquidity ratio is what it basically tells that the how much company is able to pay its short-term debt. That is, it measures a company's ability to pay off short-term debt. It further includes current ratio, current ratio, current assets minus current liabilities, quick ratio, current assets minus stocks, minus prepaid expenses upon current liabilities. Now, then financial leverage ratio, it basically tells that the financial risk, that is the debt. Debt is borrowed money. Debt is what? Debt is again a borrowed money. It basically, this type of ratio compares the company's debt with all of its assets, with all of its equity, share capital, with its earning, with its profit. So in this such type of ratio, it tells that how much a company is able to pay its long-term liabilities. We have seen in liquidity ratio that how much a company is able to pay its short-term liability. See, from the name itself, it is clear. Liquidity means how easily you can convert your cash into liquid form. That is liquidity. That is for short period of time. Whereas financial leverage, it will tell a company's financial health that how much a company is being able to pay its long-term liabilities, long-term debts. See, generally a company takes debt for more than a year. So it includes all these things. Equity ratio, debt assets ratio. So these are the liquidity ratio, current assets by current liabilities, cash ratio, net working capital ratio. Then for solvency ratio, we have debt to equity, debt by assets, debt to capital, debt by total shareholders equity. So what is total shareholders equity? It is total assets minus total liabilities. And in liquidity ratio, we have current ratio, net margin, net income by sales, sales by total assets. We have different ratios for comparing, for analyzing our company's financial health. Done. So we have completed our next unit of credit management, analysis of financial statements. So I hope you have enjoyed the session. If you have enjoyed the session, kindly like the video. If you feel that these videos are helpful to you in any manner, then like the video and share it with others as well. So tomorrow again, I'm coming with another unit of module C. So stay tuned with us. Do join the sessions from 8:30 to 9 ABFM and 9 to 9:30 ABM on YouTube if you are a non-paid learner. And if you are a paid learner, then you can join my classes at 7 p.m. daily and 8 a.m. in morning, 7 p.m. in evening. And all these sessions will be conducted in English. Let's end this session. So I hope you have enjoyed the session. Till then, take care, everyone. We'll meet you tomorrow at the same time. Stay tuned with us. Keep studying, keep watching.